Hello and welcome to this special webinar from Fat Profits. Thank you for your company and your time today. My name is Roger Malik and I am the Head of Client Services and the host for today's webinar. And joining us today is our equity analyst, Gary Burton. Gary, welcome to the webinar. How are you today?
Very good, thank you, Roger, and welcome everyone.
Great, good to have your company. And look, as the title says, gold ready to shine. So in our opinion, gold is something which is now forming a very good base, and we believe that gold will actually have a fantastic run in the months ahead. So that's one key topic we're going to discuss today, but we will also look at the markets, and we're going to provide our opinion on where the markets are at currently, where they think they're going in the next 6 to 12 months. We will also have a breakdown of a strategy which you can deploy to navigate through these choppy markets. And we'll talk about inflation today. We'll look at some dividend stocks. We'll look at some gold stocks, ETFs, and then we'll also look at some technical analysis ideas that we recently had an education workshop on. So there's a lot to discuss today. So stay tuned. We'll try to get all of this done in about half an hour, 40 minutes max. So we'll breeze through all the topics. If you've got any notes that you want to take down, please feel free to get a pen and paper handy, and we'll be as quick as we can to provide a market update. Now, before we get into the discussion, just a bit of housekeeping first. All our presentations from Fat Profits are general in nature. We don't provide personal advice. If you're looking for that, please see your financial planner or advisor. And also, past performance is not an indicator of future performance. We're happy to take some questions in today's webinar. So you can ask those questions by typing them on your chat box, where you can see that now, the orange arrow, and we will be happy to answer them live during the session and more towards the end. And finally, let's get started. So market update. Let's have a quick look at the markets first, because I think everyone, Gary, is looking at where the markets are going, because people are worried they've lost some money this year. There's been some winners, but some losers, and people want to know. So let's dive straight into the US S&P 500. And this is a chart over the last 12 months. And we can clearly see a bear market where the general trend is down. But Gary, how do you see these bear market rallies that we've seen 2 or 3 of now, and we're in a bear market rally at the moment? How do you see the S&P 500 chart currently?
Yeah, so you're quite right. We're in a bear market rally at the moment. We're still below the downtrend line there, but there's been an interesting development over the last couple of quarters, and this is the divergence signal that's arrived in the index. Now, these are a very powerful signal. Ultimately, they take time to manifest themselves into new trends, but it is a very important development in the indexes. Currently, I think we'd expect some form of retest of the downtrend line, and we'll see what happens from there.
Yeah, sure. Look, there is formidable resistance here. You can see that downtrend line. It's been, the market's been bouncing down from that twice, and now we're sort of approaching that one more time. And there is seems to be every chance that around 4,100 points there could be some heavy resistance, but time will tell. So for the timing, the trend is your friend, and it looks like it's likely to continue. If you look at the ASX 200, Gary, the Australian market has remarkably held up pretty well. How do you see the ASX?
Yeah, we're in a much better place than the US market. We haven't made the new lows as the US market did recently, and we've actually broken out of our short downtrend line, as you can see there, and broken above the last resistance point this week. So a really important development, and again, off the back of that divergence that developed in the previous 2 quarters. So a really nice looking, we're not that far from the top here, from 7,700 top. We're within short distance of that. So we are in a really better place overall, I think, than the US markets. Our market seems to have a little bit more support underneath it.
Certainly. Look, the financials in particular in Australia and the mining companies, they've held up pretty well, energy in particular as well. Let's have a look at the bear market phases. And this is a typical reflection of bear markets over hundreds years of data. And every time there's a bear market, which we are in now, we've seen it usually goes in 3 phases. And typically the third phase is usually the strongest phase, where really people throw in the towel. They actually push the sell button and they just can't handle it anymore. At the moment, we haven't seen much of that just yet, but our view at Fat Profits, Gary, when do we think there could be a potential of the third phase of another leg down in the market?
Yeah, I'm not discounting the idea that we're going to get a Christmas rally into the end of this year. Certainly it looks like that, but what we're more concerned about is US reporting season in first quarter next year, where we may see some of the inflationary pressures come through into the balance sheets in there. Now, one of the things that we have noticed, there's a lot of corporates taking risk off at the moment. They're reducing their outstanding debt as best they can in this current inflationary cycle. So that may take a bit of heat out of the downside, but certainly we're expecting some form of downgrades and earnings reductions in the first quarter 23.
Well, that could be a fantastic time, in our opinion, to look at potentially putting some cash into play. And that's one of the things we're looking at, and we'll talk more about it in a moment. But here's an example of a 12 months chart where you can see a market bottom before, 6 months before and 6 months after a market bottom. So right in the middle, you see when the markets actually have bottomed. So what this is showing is if you were 6 months too early, what would be your returns in a year? So that'll be -7%. If you were 3 months too early from the market bottom, you would get about 5% return in 12 months following that. If you were 1 month too early, you'd get 21% return. And if you bang on, look, everyone wants to be finding that market bottom. That's what everyone seems to be now waiting for. If you could find that needle in the haystack, and you can time that absolutely perfect, you'd get a 36% return. This is the index in the 1 year following that. So that'll be ideal, of course. However, even if you were 1 month late to the party, you still get a 27%, 3 months, 22%, and even 6 months too late, you still notch up a pretty decent 20% return. So all in all, what we're trying to show here is, no one might get the absolute bottom of the market, which we're expecting at some point next year is the final phase. And maybe that might happen in the first 6 months when the corporate earnings really have a downgrade. But either way, it's better late to the party than too early is our opinion. So we're going to be watching this space very carefully. We're doing a lot of research every day and every week at Fat Profits, and we provide these market updates to you on a regular basis. So something to keep an eye on for next year. And I think if you look at the next slide, you look at the corporate earnings, this is really what it's about. Recently, we've seen the quarterly reporting season in the US where they reported earnings. And look, this is probably a reflection of where things are heading. And this next representation will give you an idea. So the quarter 3 2022 earnings data showed only 56% of the total companies actually beat the earnings estimates. Now, typically, it's usually about 70% and higher of the total companies. They usually beat the earnings estimates. However, this time around, there were 56% of them. So it's actually gone lower. Now, Gary, what happens next year in the first quarter, maybe around Feb, March, if this number drops further below 50%, maybe 45% or lower, then we could see a revision of the price to earnings, a revision of stock market going backwards, and maybe that could be the final alarm bell for investors. What are your thoughts?
Yeah, it could be. And there'll be some sharp moves out of that. And this this current beat rate at 56% is not ideal, as you said, Roger. And this will be watched closely coming into first quarter 23. But there'll be some, if there is a significant increase in this, there'll be some sharp declines. But we believe that that will offer the opportunity, as you said earlier, that will offer the opportunity in equities as the last of the washout, as companies wash through their problems through the balance sheets, and we see these declines. And as you said, the third phase, and it will present some very nice opportunities in the equities market.
Well, that's something to be excited about. Look, if we get a bit of flush out in that first quarter next year, watch out, because there could be some capitulation. Now, looking at US retail sales, and that was surprising recently. We got the data. That was at 8-month high. The retail sales went up 1.3% month on month, and that was a 8-month high, which was not what the Federal Reserve wanted, because they want to see the retail sales go down, because if they go down, then inflation can be controlled. And this is really what the problem is about. If we start looking at inflation in Australia, yes, that's climbing. Unfortunately, we only get this data once a quarter, so we have to wait a little longer to get the next figures, but it's expected to tip at around 8.5%, maybe 8.8% by the end of this year. That is expected to be the top. Time will tell. In US, it seems pretty clearly that we've seen the peak of inflation at 9.1%. It is finally coming down. However, there is more to come. But if retail sales continue to go higher, that might change that, or at least pause the downgrade for the time being. UK, on the other hand, gee, they can't get it by a trick at the moment. Their inflation numbers are shooting up, gone up over 11%. That is crazy. If you look at Eurozone, that's not touching 10% now. So Gary, maybe a quick word on your thoughts on inflation. Obviously, it's a bit of a mixed signal. With the exception of US, it is going up in most other places, including Australia and UK.
Yeah, one of the important metrics behind that retail spending number that you mentioned earlier was that there's also been a significant increase in US credit card debt as well. So it seems like the retail buyer is moving their expenditure across to credit cards at the moment, and that will have a finite point. Sometime we believe that will be, we see that earnings downgrades come through next year. We may see a movement in the unemployment rate, and then we'll start to see this inflation really start to come under control, we believe, after that point. So yeah, it's the central banks have really made some moves on this. New Zealand made a very big move today against this, so they are doing their best, and there will become a time where these numbers start to decline.
Yep, absolutely. So they will decline at some point. Now, what is their plan? So we're happy to share our plan, and I'm sure for those of you watching this webinar today, you might have a plan, and if you don't, maybe this is a good time to reconsider with what's happening around the world. But the old saying does stand true. If you fail to plan, you do plan to fail. So at Fat Profits, we have a 4-point plan, and part of that is staying defensive, raising cash levels to a decent level, and we'll talk about that in a moment, avoiding speculative stocks because they're the first one to be sold when markets drop, and we've seen that this year, and finally, staying patient. That is very important. So let's break it down. First thing first, look at defensive stocks. Look, there's a number of them in Australia, of course. We know the big blue chip companies, including, the financials, your Telstras and so on. They are defensive stocks. So holding some of them will ensure you don't lose as much capital. Number two, you continue to collect your dividends every 6 months, and you stay in the market because, there will be opportunities for these companies to provide you some return on your money in the months to come. Now, this is a screenshot from one of our daily emails we sent to our member base, and this is our CEO saying, stay defensive. It is still too early to deploy the cash with the SPX, which is the S&P 500, likely to remain under pressure and yet to form an important bottom. So we are waiting for that final capitulation, and that's going to happen, in our opinion, sometime next year. And we're watching every day and every week. So that's important to stay defensive. Number two, raising capital, raising cash levels. There has never been a better time to have a good amount of cash than in today's market. Why? Because we think next year there will be that opportunity, as we discussed earlier. So how much cash is good? That's going to be the next question. Do you have 5% cash, 10%, 20%, 30, 40, 50%? What is a good level of cash? Well, it does depend on your own risk appetite, so there is no right answer. However, we will share our current cash positions. Happy to announce that. So Angus, our CEO, is currently sitting on 30% cash in the Australian portfolio that he manages, and he's sitting on over 60% cash in the global portfolio that he manages. So that is a very high level of cash for a fund manager. However, he's confident. He's just returned from a conference in Singapore with JP Morgan and their Asia Pacific conference. And yeah, he's come back completely convinced that his position is very strong, and he's very excited about the opportunities for next year. And part of that is his daily emails that he writes to our member base. And a lot of these explain where we see the markets today, where we see them tomorrow. And right at the bottom, as you can see, I won't read everything, but right at the bottom, he says, stay defensive and hold plenty of cash, around 25% in a standard portfolio. And that's what we are suggesting as a bare minimum. So that's something to consider. Now, who's Fat Profits, who we are, what we do? Look, some of you already know, and look, we're not stockbrokers, so we're a stock market research firm. He's Angus, our CEO. He's not only a fund manager, but he used to be a stockbroker years ago. And you know, he opened the company in 2000, where we have our Sydney head office. We also have offices in London and Auckland. We also have a wealth management division where we manage real money. We cover many markets around the world, including Australia, of course, but Asia, US, UK, Europe, and emerging markets. So what we do is we provide research and stock recommendations to our paid members who pay an annual fee for subscription, and in return for that annual fee, they get daily, weekly, and monthly updates on the markets. So we've been doing that for 22 years. And here's a picture of our mining analyst, David Lennox. He's also a geologist. He's been with the business for 12 years, but in the markets for 30, 40 years. He's well renowned for his resource and mining research, and he's on CNBC, Bloomberg, and Ausbiz, and a lot of these channels on a regular basis. So you may recognize that name or the face. And finally, we also have a wealth management division where we manage real money. And this is a chart which shows you the returns of our funds in the Australian market, which is the orange line, versus the black line, which is the ASX 200. So we launched this in 2007, and you can clearly see after the setback in 2008 when we saw the GFC, our funds have actually grown and grown and grown, and actually nearly tripled the ASX returns. So that is a fantastic result for people who put in money with Angus and his team, and we have returned that in kind. So that's actually done quite well for us. Number 3, Gary, maybe I'll get your help on this one. Avoiding speculative growth stocks. Why should one consider avoiding them in this sort of market at the moment?
Yeah, the speculative stocks are great when announcements come out, but unless they're actually producing something, there's often capital raises, there's often discounts in share prices along the way until they get the business up and going, and then getting the business up and going is usually a 50-50 outcome in a lot of cases, particularly with the speculative mining stocks. So we're really more interested in some companies that produce something, that have an income, and that's really our focus here at Fat Profits.
Absolutely. And look, here's a couple of examples, and I hope you don't own these stocks because you probably want to look away right now. EML Payments, look, that's a stock which has lost more than 90% of its value in the last 12 months alone. I mean, that is a terrible looking chart, but a lot of people want to catch a falling knife sometimes, and they think, oh, well, it's gone from $6 down to 50 cents. Surely looks cheap. But look, there's more to it than just that. and we're avoiding these highly speculative stocks at the moment. The fundamentals is really the key, and that's not looking good at the moment. So we're avoiding that. Another example is Xero, the accounting firm. Look, that's also had a phenomenal fall in the last 6 months in particular, and it's gone from $160, $155 down to $65, $68 now. Some might say it looks cheap, but look, at this point in time, we will avoid this. There will be a time for some of these companies when there'll be a turnaround, but that remains to be seen, and we've had to do our research, because look, without research, it's a stab in the dark. And you know, at Fat Profits, that's what we do all day long, is research, 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 and we look at fundamentals. So these companies are a couple of examples of what you want to avoid in today's market. Now, the fourth and final part of the plan is to stay patient. Look, there will be opportunities galore next year, in our opinion. Now, what we've done is we moved a lot of our stocks from previous buy recommendations to hold. As you can see here, hedge means hold, and a lot of these companies are hold. And there's stacks of them that we've done research on, but we have not put buys on a lot of them. Look, some of them are still buys, but majority we moved into hold. So all in all, the 4-point plan is back on your screen now one more time, is stay defensive, raise good levels of cash, 25% bare minimum, more for some who depending on your risk appetite. Avoid speculative growth stocks in this market. There will be a time to buy them, but it will be more like next year. And finally, stay patient. There will be bear market rallies 2 or 3 times, maybe 4 or 5 times before we finally see a bottom. Don't have a fear of missing out. There will be opportunities to make money. Now, let's talk about the big picture today, Gary, is gold. Now, that's really what we're excited about, is gold. Now, why? Let's have a quick look at a couple of things first before I pass it on to you. One of the key things is the US dollar. Now, the US dollar has gone up against all currencies this year, and here's a quick snapshot. And Gary, let's talk about the greenback first. What's caused the US dollar to rise so heavily this year, and how does that impact gold?
So we saw US bond yields rise quite sharply, and that the cause of that, or the result of that, I should say, is that there's been a strong flow into the US dollar to take advantage of that. Now, the market's sensing that there's the top is in bond yields at the moment, and we've seen now a significant decline in the US dollar. What really got our attention on this was this impulsive movement several weeks. This is a weekly chart we're looking at. A few weeks ago, we saw this significant impulsive decline, which broke the trend line, valid trend line underneath, and broke the trend line, and really broke the back of the US dollar trade there. And since then, the last 2 weeks has been very small ranges. We can also see the relative strength of the index has now broken down below the 50 level after coming out of the 70 level. So that's also indicating a true loss of momentum in the US dollar index. Now, this is going to be very, very good for commodities going forward.
Well, that's a great sign of things to come, we hope, because commodities are pretty much all priced in the US dollar. And here's a quick example of some of them this year. Gold, look, actually, if you really think about it, a lot of people say, oh, gold hasn't done really well this year. Well, when you think about it, it's only down 2.75% year on year, whereas the greenback has gone up 15% this year. So if we look at the gold chart, how do you see this one, Gary?
Yeah, this is a great chart. There's been a lot of news over the last couple of weeks about this breakout. You can see I've marked on the chart there this impulsive move, almost the opposite of the US dollar index, but the impulsive move there has captured a lot of attention, but it's been building over several months. And I've marked the 3 lows in the chart. Very good technical setup there that really was the backbone of this impulsive move. The market couldn't go lower than those points at the time. And now here we are, we've had the breakout, and currently we're consolidating outside of that trend line. And also we can see that the relative strength has moved up to the 50 level. Very, very good sign. This is a weekly chart, so long-term view of this. very good chance that gold is going to continue higher from here once we finish with this consolidation period and we get some more news around bond yields and such, and we'll see this push a little higher. But big support level held just below the $1,700 level, about 1686. Big support level through there is held up now, and we're looking for more upside in this.
Well, this could be the trade for next year. I mean, really, there is a lot of upside here, Gary. And just going back to the US dollar chart, and if this trend is now broken and this continues to fall away back down to 100 or even lower over the next 6 to 12 months, gold could potentially hit these previous all-time highs of 2,000 US dollars, and currently it's around 1730. So there is a lot of upside here, which is what we're really excited about. So can we look at a couple of examples of what our audience today can look forward to?
Well, the real proof of this is coming through. This is the VanEck Gold Miners ETF, and we can see over August, September, October, it's really put in a nice base, a nice rounding type of base through there, and it currently broken through resistance and retested it over the last few days, and then now it's starting to rally again, and we're seeing that the relative strength underneath there, relative strength is continuing to rise as well. So the internal momentum of this particular ETF is gaining positive momentum, as we say. So the market's very good discounting machine is effectively on the long side at the moment, not the short side as we saw on the left-hand side of the chart. So we believe there's more upside here as well.
Great. So if an ETF, because this would obviously have a bunch of gold mining companies starting to show signs, so that's underlying positive momentum there. Okay, let's give away one stock recommendation that our audience today can walk away with. So Northern Star, one of the big producers of gold in Australia, merged about 1.5 years ago with a company called Saracen Minerals. So they're now combined and all under the umbrella of Northern Star. It is a buy at the moment. Tell us more, Gary. What do we like about this company and certainly the setup as well?
Yeah, this is basically a tier 1 gold company now with some very good long life mines in its portfolio, and it's starting to show here. We can see on the price chart the higher low that I've marked in there. Relative strength is gaining significantly. The stock is moving up into a previous consolidation zone, and with a $12, about $11.80, $12 resistance level. So there's lots of room for it to move just yet. But we believe that this is really just the beginning of these potential moves for the gold stocks. And I emphasize the producers here. And we saw in the VanEck ETF, that's the ETF of producing gold miners. So the gold miners themselves, they're starting to show a bit of life and very, very interested. And we have a number of them as buyers.
Yeah, we have a number of them. That's the key. Not have just one or two in your portfolio. Spread your eggs in different baskets. Northern Star, look, yeah, they've come off from $6.70, $6.80, which was the low, and now gone past $10.20 and so on. But look, keep in mind, this was at its peak was at $17. So there is a lot of upside when gold does continue to go higher over the coming 6 to 12 months. You will require a bit of patience. There will be volatility, but if you've got patience and you've got medium to long-term view, this is one stock you can add to your watch list and do a bit more research on. As a general guide, we've got a buy on this at the moment. Now, there's a number of other stocks we can talk about, but outside of gold, we also produce an income portfolio, an income report every quarter. And here's a couple of screenshots to show you sort of quarterly updates. And this portfolio of dividend stocks is designed for our self-funded investors who are using the stock market as an income strategy. They want dividends every 6 months. And we have a basket of 22 stocks, which are in financials, industrials, and property. And this portfolio has been producing an average return of 17.1% per year for the last 10 years in the market. Now that 17% is a combination of dividends and growth. And that's what we would, of course, we all want to get as high as return as possible, but we do think 17% is quite good. You know, if you're doing better than that, great. But if you're not, this is a portfolio you can pretty much mirror and copy, because only 22 stocks, so very carefully selected, well-researched, top 200 ASX companies. Here's an example, and you can see a couple of stocks on the left. We're happy to share a couple, but these stocks, this table shows the net yield for financial year 22, financial year 23, and gross yield for financial year 22 and 23 per stock. And on the right-hand side, it shows the franking credits per stock. So some are fully franked 100%, some are unfranked, which is the property stocks on the bottom. But all in all, you can see financial year 23, there's a few stocks even gone past 10% yield per year, which is pretty healthy. But there's quite a few at 7, 8, 9% even. But overall, the portfolio average is 6.6% across 22 stocks. And that's what we're expecting as a dividend yield, which you tell us, would you agree that that's a good return on dividends? We think so. And when you put on top of that another 9% or 10% in growth, getting you closer to that 17% mark, that's a pretty good result. So if you want to check that out, well, that's obviously in our members area. When you're a member, you've got full access to this income portfolio. The other thing we're happy to share is that we've been selling down a number of stocks this year. Here's a list of some of them. If you own any one of them, you can check them out now. We've sold quite a few of them. Some of them are sell halves, bear that in mind. Some of them are full sells. And the last couple of sells at the bottom, you can see Hub24. That was a stock we've had it for a very long time, and we've taken a pretty significant return on that one, 1,600%. And look, if you'd invested 10,000 per stock, that would be your return per stock. And look, we don't get all of them right. There's a couple of them where we lost some money, of course, but a couple of the others have really cleaned up. All in all, we advocate, you know, spreading your eggs in different baskets. So if you give yourself a better chance, that gives you the highest probability of return. Now, let's have a look at something quite exciting. Now, how many of you would you say are good at technical analysis? How many of you can say, if you give yourself a score from 1 to 10 on charts, patterns, indicators, getting, you know, the money management right, stop losses, etc., what score would you give yourself? You know, if you say you're 5 or a 6 or a 7, and you think there is room for improvement, we have some great news for you today. Because recently, Gary and I both conducted a technical analysis workshop for our members, and this was a paid event. So they paid to walk into that workshop for 2 hours, and we went through many topics. We have got a recording of that session available, and we can give that away today to some of you, not all of you, some of you, if you're interested in expanding your skills and improving your technical capabilities to become a better investor, a better trader. Now, just before we explain how that works, Gary, can you highlight a couple of key things we're going to talk about just briefly that we talked about in the workshop?
Yeah, we kept the workshop for the retail investor. Now, I'm a retail investor, so it's was kept just along the basics, what you would look for in particular chart patterns, in particular timeframes, what you might look for to affect an entry into a stock, and then the support levels and resistance levels how to mark them off correctly, and along that. So you've got some at least consistency in your charting, and then the consistency will build a consistent trading plan.
Absolutely. So some examples here, you can see a bit of a support and resistance, how to use that, and identify breakouts. Another example, what we shared, is how to use Bollinger Bands. That's something some of you may have heard of, and how to use some simple moving average to look at Bollinger Bands. Another example of a detailed discussion we had was moving average crossovers. What are some examples of entries? And you can see a couple of very good indicators here on entries when you see a breakout, and exit when you see a bit of a turnaround, and how to use that successfully as an investor. We also talked about one of the best tools that Gary loves, and I personally have been a big fan of that ever since Gary's taught me about this, is the bullish and the bearish divergence. And we showed that earlier in a couple of the charts, is how to read a divergence where things are going in one direction and the stock's going in different direction, and that usually follows suit. So this is a very powerful indicator. We also learned how to use successful support and resistance levels, because they can be very powerful when used correctly. And here's an example of, drawing your support and resistance levels, and when to exit or enter a stock there. So these are a few examples of what we discussed in the workshop. Now, how can you get a hold of this? We're just going to explain to you in a moment, but we have some good news to share with you just in a minute or two. Now, before we do that, let's quickly talk about our Fat Profits performance. Now, this is all in our website. You may have already seen this. This is not new to most of you who know Fat Profits, but our annual returns since inception, since 2000, are over 17% per year for 22 years. That's a very long time. And markets at the same time have done 8.5%. So we've beaten the market over 9% per year. And here's a few years that you can easily see a breakdown. Although we get it right quite often, we don't get it right every single time, but we outperform the market more often than not. The other thing which we're very proud of is, our members really writing up some, messages on an independent website, product review, where we have 4.1 star rating. But we're not perfect. Look, we don't get everything right, but we do get quite a few things right. Here's a few examples from members writing down, lost without them, or best ever investment, and so on. Look, Dave here has written a 5-star review, been with us since 2009, and has extended for another 5 years. Look, people wouldn't be with us for such a long time if we're not doing something right. So you must take that into account. We also got some other satisfied customers who've written reviews, even a retired fund manager like David Galloway. He's a retired stockbroker as well, so written pretty long and appreciative review for us. Penny here, she's written a pretty long one. So you can find them yourself, do your own research and make up your mind. But look, a few reasons we're going to give you today to consider joining our service. A very simple service. First reason is our performance. We've done over 17% annually for 22 years, very long time. You're going to find it very hard to find someone who's done that. We save you time on research, and this is the key for a lot of our current 25,000 members, is they don't want to look at markets every day. So we do that for you. You pay a small fee. We have experienced, reputable management, good research analysts who study the market every day for you. We get 7 out of 10 winners. So as we said earlier, we don't get all of them right, but we get 7 out of 10 right. That's pretty good. We give you guidance in the market like we're doing today. We give you our views on where we see the stocks going, and we tell you market direction. So these are a couple of key reasons. The other thing is we don't do any additional marketing or additional upselling, because that's something we all hate. We don't actually have any other products to upsell other than our simple subscription level. So even if you wanted to, we can't. And the final one is we manage real money, up to $1 billion, and that's spread across Australian and global portfolios that Angus and the fund managers. So what do we have here? We have 3 products, very simple: standard, premium, and platinum. All you need to do is pick one, and that's yours. We can do a very good deal for you, which I'm going to explain to you in a moment, but just firstly quickly explain the difference. So standard members, everyone gets a daily email, which is the daily Fat Chat market commentary every morning. Hit your inbox around about 10 o'clock in the morning from Angus, straight from the fund manager into your inbox, tells you where the markets are going. Very good email, You're going to get a lot of quality research at your fingertips every morning, Monday to Friday. Second benefit is you're going to get a weekly members-only webinar, which we conduct on a Thursday at 12 p.m. Sydney time for 1 hour. And Gary, you're part of that webinar on a regular basis. How would you rate the information that we share in the webinar? What do you think are some of the highlights?
Well, one of the highlights, of course, is that members can ask questions if they're not clear on something or would like some further information about the stocks that we review. But we go through our recommendations for the week and explain the reasoning behind them. And so that's, also valuable information so members can assess their risk in the stock and take away, what they need for their portfolios.
Absolutely, well said. The good thing about the webinar is it's recorded as well, so you don't have to watch it on Thursday. It's recorded, you get an email copy. It's also on our website, so you can replay that at any time, and that's a good benefit. Third is Friday Fat Wrap, which is a wrap up of any highlights of the week that you may have missed out on. So those first three benefits are common in Standard, Premium, or Platinum. The key difference is with the Standard, you can choose one of our 3 reports. With Premium, you can choose 2 out of the 3, and Platinum, you get all 3. So the 3 reports are Australian equities, which obviously covers the Australian market, and we give you its weekly report, comes with 4 to 6 stock recommendations, buy, sell, or hold every Tuesday. So you get it once a week for the Aussie market. So that's the first report. Second report is Global Mining Report. And now don't be confused by the word global. It's a mining report. So it really covers majority of Australian mining companies, but also has a mix of international mining companies. So if you're really interested in mining, whether it's gold, lithium, nickel, iron ore, rare earth, you name it. It's all there in the mining report. So that is a second option. And third one is Global Equities, which covers international markets, including US, UK, Europe, and Asia. So if you're interested in one of those reports, you can just become a Standard member. If you want 2 of those reports, which is what majority of our members have, is a Premium membership. They have the Australian equities and the mining. Plus, you also get a Premium account manager, which means you can speak to your account manager. If you have questions, they can guide you, they can clarify things for you. You can email them as well. If you're busy, just email your questions and they'll reply back. So that's a good benefit to have, and our members appreciate that. And that's a point of difference between us and some of our other competitors, which are pure email service only, whereas we have account managers you can speak to. Platinum is all inclusive. So you get all the reports, you get the account manager, you get the bells and whistles. So it's up to you. Either one of them, we give you a tax invoice. They can be invoiced to your super fund or your own personal name, whatever you prefer. Now, what's the damage? I can hear that question in my ear. How much does it cost? So let's explain that now. So first thing first, we have a Black Friday sale. You must have heard of that one. It's all around the markets, and we're not any different. So we're offering up to 50% off for you to take advantage of. Now, these are the best prices we've offered all year, and we have probably the easiest offer on Premium, where 1 year, the normal price is $1,545, inclusive of GST. We're offering nearly 40% discount, and that's down to only $995. That's fantastic. The second offer, you can take a better deal, 2 years for the price of 1. Normally it's $1,545 for 1 year. We're giving away 2 years for the price of 1, a full 50% off. So your average per year is around $770 per year for 2 years. And of course, that is exceptional value in our opinion. So you can take advantage of one or the other. What I'm going to do is also let you know, remember what we talked about earlier, and I'm going to just put that up now, where you can register your interest now and let us know if you're interested in the 1 or the 2 years. But we'll wait, there is more. We also have, remember that workshop, the education workshop that we just talked about. We are also giving that one away today for free. to anyone joining our service. Now, whether you take the 1 year at $9.95 or the 2 years at $15.45, either of them, we will include that paid workshop absolutely free of charge, yours to keep forever. It'll be emailed to you as a recording, and you can replay that over and over again. It's a 2-hour recording, remember? And you can also forward that to somebody that you know in your family who might benefit from learning more about technical analysis. So all that combined as our gift to you as a free gift as part of 1 or 2 years service. And we know that you can benefit from our service over the next 1 to 2 years as we navigate through these markets and we come out on the other side of this bear market and we have a bull run. And that's what our plan is. So on that note, I can see here a few people are showing their interest. I'll take one quick question, which has come from Helen. Helen is asking about, let me just quickly read this here. So Helen is saying, I'm an ex-member of your service and I enjoyed the presentation so far. I agree with the gold view. I do have one gold stock in my portfolio. If I'm interested in signing up to the premium service, can I pick any 2 reports, including the mining? Yes, Helen. So with the premium service, you get 2 reports out of the 3. So if you want to pick the mining, which we encourage, you can choose that, and then you can go with either the Australian equities or you can choose the global equity. So you can choose any 2 out of the 3. So we're going to do that for you, and whether you go for 1 year or 2 years, we'll leave that with you. Next one is a comment actually from Jonathan. He's saying, thank you for the workshop idea. I think I will take up the 1 year offer because that workshop sounds like something I can benefit from. Okay, Jonathan, thank you, appreciate that. All you need to do is just click on I'm interested. We will call you and organize the 1 or 2 year deal for you. It's not to be missed. It's a great deal, you might add. All right, all done. I'm going to close that now. I think those of you who've got an open mind, you've already shown your interest, so we won't go any further. I'll close that now. Thank you for your registrations. What that does is brings us to the end of today's webinar. And look, if you've taken anything away from today's webinar, please feel free to email us at info@fatprofits.com.au. Any comments or thoughts or feedback would be appreciated. And my name is Roger. Thank you for your time today, and I'll pass it on to Gary for his final words.
Yeah, thank you, Roger. Thank you, everyone. So I hope you enjoyed that, and we really think you will get some benefit out of that particularly if you're self-managed super fund or have a trading account that you're looking to grow. So all the best with your trading, and we'll look forward to seeing you on board.
Okay, bye for now.